5 employees. Now we have over 19 offices just in Australia alone. We're in 5 different countries around the world, and we're actually the largest Australian brokerage now, which is great in not many years at all. The startup network is something that we actually strongly believe in at PSC. PSC's background being a startup itself, our board has a vested interest in contributing back to startups. The number of board members that we have actually have their private equities, and they invest in a lot of startups around the world, especially those that are contributing towards the insurance industry. Gareth and myself, personally, we really love being involved in the startup network. We love to just lay witness to the changing landscape that you as the founders are creating. Our intention is just really to be there, support you from a risk management aspect, and watch you grow. All we can do is watch you exceed expectations, outgrow us, hopefully, and become Australia's next unicorn, just like PayPal did. Not Afterpay, sorry. I'll pass over to Paul. He's our life insurance specialist in our office, so take it away.
Thanks, Amy. Thanks, Gareth. Thank you, Ryan. Today we're going to have a bit of a chat about business insurances and more the ownership partnership structures and what types of insurances startup groups should be looking for or looking at, especially when the business starts to grow. PSC Life, obviously a part of PSC. I think at last count we represent just around 1% of the overall PSC company. So we're very small from a PSC point of view, but the role that we help with PSC ensuring the businesses and in particular the business owners is invaluable to a lot of our clients. So we might start with my presentation if Ryan, if you can share that one for me. Thank you very much. And we'll just click through to the disclaimer, which we need to get through. So basically anything we're about to say is general in knowledge or general advice. It's not to be considered personal advice. So don't rush off and make any changes after you've heard me speak today. If you are going to make changes or you want to, please seek the advice of your financial planner, your insurance broker. If you don't have one, well, obviously we would love to partner up with you as well. So that's my legal commitment out of the way. We'll get going. So a little bit following on from what Amy said, Ryan, if we can just go to the next one, please. So as Amy mentioned, PSC has got a proven track record of buying, growing and developing businesses around the insurance services industry. We've got 19 offices, as Amy said, across Australia. We've got offices in the UK, Hong Kong, Vietnam, New Zealand, and the US as well. And all this started from a small company just down the road here in South Melbourne around about 15 or 16 years ago. So the growth in PSC has been phenomenal over that period of time. Next one, please, Ryan. We advise around about 80,000 clients across Australia from the larger PSC network. PSC Life, as I mentioned earlier, is about 1% of that. We've got PSC Insurance Brokers, which is obviously Gareth and Amy, and network partners, which are self-employed as well. But we provide insurance advice globally to about 100,000 clients, which represents quite a large. I think as of last count, PSC was the largest brokerage in Australia. And that's just some of the companies we have. We have PSC Workers Comp, which is WCS, PSC Life, SafeX, PSC New Zealand, and of course our main one is the broking network, PSC Insurance Brokers. The PSC Life team, we've got 5 risk specialists, 2 based in Melbourne, which is myself and another planner. We also service Brisbane and Gold Coast offices, regional Victoria as well. We've got 2 planners in New South Wales, which service Goulburn, Canberra, Sydney, Newcastle, and the other New South Wales offices. And of course, together we also service Western Australia, South Australia. We have an office up in Darwin we service as well. We've got 6 support staff, 2 full-time claims people in our claims. We'll speak about life claims further on in the slides, but that's a very important part of our business. Obviously, we're in the business to provide funds in the time of need and to make that transition as quickly and as smoothly as possible. Just makes life a lot easier for our clients, in a very stressful time, because it's always a stressful time going through an income protection, life claim, or trauma claim. 4 main areas we look at from PSC Life team's point of view. We look at life insurance, and we'll go into a lot more detail in these in a moment. But life insurance, TPD, and I'll refer to as TPD throughout the slides, but TPD stands for total and permanent disability. That's pretty much you're not coming back to work. Income protection and critical illness. Some companies call it trauma. Most call it critical illness these days. Critical illness is probably the preferred wording on that one. Trauma can, people think they're covered for a few things that they may not be. But the main purposes of what we try to function is business protection. That's for the business owner and the business itself, so that the business can continue without suffering too much. Group insurance for our larger clients, employee benefit schemes, and of course, your personal insurance, your mum and dad type insurances as well. So they're our main focus with the PSC Life team. So how do we identify a risk to a business? We look at any businesses, any SMEs that may have turnover between, it says $1 million there, but really $10,000 to $50 million. Any family-owned businesses, we do have quite a few family-owned businesses where 1 or 2 of the children may be involved in the business, and there might be other children that aren't. And how is that equity distributed on transfer or on death of the parents, perhaps? And how do we make that as equitable as possible for the children? Any partnerships or any business that have a partnership agreement, or how those shares are transferred on the death or disability of one of the major owners, and we'll go into a lot more detail in this, and that goes for businesses that may have multiple shareholders or partners, businesses or key person businesses where they're relying solely on 1 or 2 employees of the business to bring in a lot of the income. We look at those, and of course any business which may be, a lot of these startup network businesses that have capital investors as well. So any business that's taken capital from an outside source, that outside source may require the key person or the business owner to have some form of insurance on them if something were to go wrong, that they can get their capital back. So that's how we try to identify our key risk from a business insurance point of view. And we'll go to the next one. Thanks, Ryan. So as I said earlier, that from a business insurance point of view, there's 2 main types of insurance we look at: buy-sell cover, or buyout insurance, as it's sometimes referred to. And that's simply when there's a number of owners, and it could be a simple case where Amy and I own a business together. Something happens to Amy, I need to buy her shares out because her family has no idea about the business, or does not want to be involved, and it just provides an easy transfer of ownership of that of Amy's shares to me. If the business is valued at $2 million, for example, we're 50-50 owners, and I owe $1 million. How do I get that $1 million without selling down assets or doing those sorts of things? The other type of insurance we look at is key person. Who is a key person in the business? Someone that brings in the revenue, someone that makes the business extremely profitable, someone that guarantees any capital or loans, and obviously that can include owners as well. So a buy-sell agreement or buy-sell funding, when we talk about that business ownership that we talked about earlier, it should be when there's two owners of a business, the buy-sell agreement is similar to a will for the business. So it needs to be a legally binding document, and all owners should obviously sign that. And there's mainly two main parts to it. There's the legal document and the funding mechanism. So we'll pop on to the next one, thanks, and we'll go through those in a bit more detail. So the legal document that's usually drafted, obviously, by your lawyer or solicitor, just think of it as a will for the business. You may have your own personal wills, or hopefully if you've got assets that you do have a will, but the legal document or the buy-sell agreement is pretty much a will for the business. So it will explain to the owners the trigger events that will trigger a transfer of ownership. Usually that includes death, retirement, TPD, total permanent disability, and usually that's about it. We don't normally include trauma or critical illness in the buy-sell, because with a trauma event, you would hopefully recover and be back in the business in 6-12 months time. So therefore, you haven't been forced out of the business or forced to retire early. The other parts of the document, how the sale price is determined. So as long as the methodology is determined, and this can be determined by your accountant or your bookkeeper or yourselves, it could be a multiple of profit, multiple of turnover, EBITDA, whatever agreement or whatever methodology you agree on, as long as it's documented, there shouldn't be too many arguments at the time of transfer. Payment arrangements, how it's going to be funded, and of course, as I said earlier, the process to follow on that trigger event. So God forbid anything ever happened to Amy. Sorry to do this to you, Amy. Amy's passed away, then we follow the agreement, and it should be a step-by-step process on how the shares are transferred. Amy's shares are transferred back to myself to become the majority share owner in the business. The funding mechanism, as I mentioned earlier, there's two ways to fund it. If I've got a spare $1 million floating around, I can just buy out Amy's family and we just continue going. Fantastic. Unfortunately, I don't have a spare $1 million in my bank account. So how do we fund that? So usually we put in place an insurance policy which would pay out on those key events, being death and or total and permanent disability. And those funds, and when I get paid that amount of the $1 million from the insurance policy, transfer that to Amy's family. Amy transfers the shares back to me again as the steps in the funding in the buy-sell agreement are followed. As I said earlier, if you don't have the if you don't need the insurance, if you've got that spare capital floating around, that's fine. But not a lot of people have that sort of capital just floating around in cash accounts where they can access it quite quickly. So who owns the policies on a buy-sell funding agreement? You can self-own the policies. I own the policy on myself. Amy owns one on herself. Something happens to me this time. Amy, the buy-sell agreement, we follow the steps and the shares are transferred. Joint ownership is where we both own policies on each other jointly. Cross ownership, pretty straightforward. I own Amy's policy, she owns mine. The problem with cross ownership though is if the business breaks down and we lose touch or we don't talk to each other for a number of years, but the policies are still paid for. So if Amy and I have had a falling out, I'm still paying her insurance, then it can get quite awkward come claim time. Discretionary trust or company ownership, they can both be owned. I'll get to company ownership a little bit later as well for the key man. Usually if the company owns the policy, there can be tax implications. If the company tries to claim the premium as a tax deduction, the proceeds may be taxable. So that's a bit of a grey area, that one, depending on how it's owned. That's something we probably wouldn't recommend. And definitely, this is a possibility, but we don't recommend going down the superannuation fund ownership for these purposes, not for your individual insurances, but for business insurance, simply for the fact that it does get quite awkward come claim time when there's other beneficiaries nominated and things along those lines through the super fund. So it just gets very messy at claim time. So this is a real life example that we had, what did we took probably 18 months ago. And it was an insurance brokerage. Unfortunately or fortunately, I would hope that insurance brokers like ourselves would know a little bit better, but they didn't. So there was two owners in the business, a 55% ownership and a 45% ownership. The 55% owner died suddenly and was not married and had no children. His shares in the business automatically passed to his elderly mother, and now the elderly mum owns the controlling interest in the business. The 45% owner is stuck in the business. He can't afford to leave because he's built the business for the last 10 years. But now he's getting a phone call every Friday afternoon from his ex-business partner, his old business partner's mother, asking where her distribution is or her dividend. So it's it's not a good situation. This whole situation could have been avoided quite simply if they had that buy-sell agreement, that will for the business, and of course, if they had that funding mechanism being the insurance company, the insurance policy. So this happened about 18 months ago. It's still in the process of being broken up, the business, and in that last 18 months, the business profits have suffered dramatically because the 45% owner could not afford to bring someone else in to buy the other half of the business, and no one wanted to buy in whilst the elderly mother was still controlling the business. So it just became a really messy situation for everyone, which could have been easily avoided, which is a bit of a shame. So as I said earlier, we've talked a little bit about your buy-sell funding, the partnership agreement. So if there's one owner of the business, but they're employing a manager or someone, a sales manager or marketing manager who's an integral part of the business, and if that person was unable to work due to injury or illness, how will that impact the business? Can the business get a capital injection so that it can go out and headhunt someone very quickly, pay for their recruitment costs, and get someone to take over that role quite quickly so that the business doesn't suffer long-term from a negative cash flow or negative profit point of view? So there's two types of key person insurance that we talk about: revenue purpose and a capital purpose. So the revenue purpose is just what I just mentioned. We're covering lost income due to that key person not being able to work. Amy can't come into work here. The sales of PSC go down dramatically.
I wish.
we need to put a policy on Amy so that PSC can keep all the shareholders happy. But on a much smaller scale, if there's a smaller company and there is one person that's integral to bring in 20, 30, 40% of the overall revenue, that's something that obviously needs to be looked at. Capital purpose is, as I think I mentioned earlier, somewhere that your startups may be considering, that if someone injects capital into the business or into the startup, and that capital needs to be repaid if you're unable to work, that insurance policy can pay out and that you can pay back that capital to the investor quite quickly if it's a one or two man show or one or two person show. So the capital purpose is to repay loans, repay capital. The revenue is to protect the revenue creators. So just on that, with the key person insurance with revenue, usually the premiums are tax deductible. However, if there is a claim, the proceeds, that couple of $100,000, whatever it may be, paid back into the business, will be assessable income to the business. So when we are doing these calculations on how much is enough insurance, we usually take that into account, that some of that will be lost to the ATO. So therefore we take that into account. For capital repayments, the premiums to the company are not tax deductible, but then also on the flip side of that, the proceeds are tax-free. So it's slightly different tax treatments for the purpose. Now, the purpose will usually be documented in your statement of advice that's provided by your financial advisor or planner, and also perhaps in your agreement, your buy-sell agreement as well. As long as it is documented, we shouldn't have any issues with the ATO further down the track, which is obviously a good thing as well. We'll go to the next one. Thanks, Ryan. So I'll just cover, so we've covered buy-sell funding or buyout insurance, which is that partnership agreement. Key person insurance, which covers, if you've borrowed money or if there's been an investor that's invested into your startup. And of course, if there is a key person that's driving a lot of the revenue for the business, the protection on them. But what sort of insurances can we use to protect those sorts of people? So there's four main types, and we touched on them earlier, but the first one we'll talk about is life insurance. So life insurance, a lot of people will have attached to their superannuation fund, or they may have it outside of super from a personal point of view, and it's very straightforward. You pass away, or I know it's a bit of a morbid subject, but it's what we do, unfortunately or fortunately. If you happen to pass away, or you're given less than 24 months to live, some companies 12 months to live, but if you're given less than 24 months to live by a doctor, there's usually a tax-free lump sum payout to you, and you can do whatever you want with that. If it's paid to the business, if it's to transfer shares, or of course from a personal nature, take your family on a holiday before you've passed away or something on those lines, pay out your mortgage, that sort of stuff. So life insurance is fairly straightforward. You're no longer with us, it is paid out. I do get a lot of queries about suicide, and as a general rule of thumb, suicide is payable under a life insurance policy after a 13-month period has expired. So you take out a life insurance policy today, there would be no payment on a suicide event for the first 13 months, and then after 13 months, it is a fully payable event. Not the brightest of subjects, I understand, but we do get that question. TPD, total and permanent disablement. You're never working again. In my opinion, that's worse than death, because you've lost your ability to earn an income, you've lost the ability to provide for your family, but you're still going to have all the medical expenses, the rehabilitation, the doctors, everything on those lines. So that, in my opinion, is probably worse than death from a financial point of view. When we talk TPD, there are two types of definitions. There's an any occupation definition, which means you're unable to do any occupation ever again. And that's the one that's inside super. And that's the only one that's allowed to be inside super. You can pay an additional premium, or a little bit more, for an own occupation definition, which means you can't do your own occupation ever again. So those two little words, any and own, they make a big difference in the definitions, with the own occupation obviously being a stronger definition. Unfortunately, though, that's not allowed to be owned by a super fund, but there are ways that we can mitigate any additional premiums on that as well. Trauma insurance, or as we mentioned earlier, I like to call it critical illness. Trauma, someone might say that they had COVID and they were in bed for a month, and that was quite traumatic. I'm not doubting that it wasn't, but it doesn't meet the definition of trauma insurance. So critical illness is probably the better term to use. And there's, between all the different companies we use, there's usually about 45 to 50 defined events that it covers. Now, it does cover the things, it reduces the cost of a GoFundMe. The GoFundMe requests that you may see on Facebook or Instagram or something from the other parents at school or friends of the family, it reduces that. So if I'm diagnosed with one of those 50 illnesses, there's a lump sum payout quite quickly on diagnosis. Personally, I went through a trauma claim myself in 2021, I think it was, about 3 years ago. And I had to pay out in about 3 weeks' time. Mind you, I was in the industry, so I knew I was going to get that. So I had all the doctors teed up, but it did pay quite quickly, and it paid on diagnosis of the illness. So I'm just in the next couple of pages, Ryan. We've just got the it's a bit hard to read, but just as you can see there, you've got all your heart conditions up the top, your nervous system conditions, your organ failure conditions. So this is just the list of what trauma insurance covers, and this is just one particular company's list of trauma events. And if we just go through the next couple of pages, Ryan, you'll see that there's the 45 to 50 events that I was talking about. So there, but that, if you want more detail on those, certainly reach out. We can get those for you as well. Finally, the last one, which doesn't really come into the business insurance that we're talking about a lot tonight, but definitely in your own personal situation, it may, is income protection. Income protection pays you up to 70% of your gross income if you're unable to work for any reason, any medical reason. It covers you 24/7, so and anywhere in the world. So you could be on holidays in Thailand, get hit by a tuk-tuk, and be fully covered. Come back and you're fully covered. The 70% used to be 75%. So income protection, a lot of the rules with income protection changed in October 2021. So in the industry, we refer to it as pre-October 2021 rules and post. The pre-October 2021 rules are a little bit better. So if you've got an older income protection policy, think very carefully before changing that to a new policy, because the new policy will not have some of the features and benefits of the older policies. It might be a little bit cheaper, but it's not going to have those benefits. So just be wary before rushing out and making any changes. So just a little flow chart. So as I said earlier, if we want to keep the business running, you're looking at probably two types of cover: key person insurance and business expense cover. Business expense is a little bit like income protection, but it's for the business. It covers things like rent, utilities, wages, that sort of stuff, but it's payable only for 1 year. So it's not very popular insurance. Business succession planning will let you buy sell funding, and then of course family protection, personal protection, your life TPD, trauma, or critical illness on yourself to cover your own personal needs. We also look at some group or employee benefit schemes. So obviously, as Amy said, we want to watch your companies grow and succeed. So when they're growing and you want to retain those quality staff, we can set up employee benefit schemes, which the company may fund, your income protection or your life or TPD to retain quality staff, and of course attract new staff in potentially. So that's just something that may not be that important, but we can certainly help out in the future. So I thought I'd give a couple of examples of how much insurance costs. If you don't have it, you probably don't know, and not a lot of people spend the time thinking about it. So we just did a couple of quick little mock quotes on a key man cover for this one, because it's got the critical illness. We did a male, age 35, non-smoker. I'll just put it out there, if you're a smoker, you're probably going to pay about an additional 40 to 45% on the premiums compared to a non-smoker. And that's across the board. That's with every provider in Australia. And that's just, another reason to quit smoking if you are a smoker. Office-based occupational duties. And for this particular quote, we've just done 500,000 life insurance, 500,000 total and permanent disability with the better own occupation. And we went critical illness 500,000 with the top of the range product as well. So if we just pop over to the next page, you'll just see the companies we go through and just the quotes on these ones. So you're looking at anywhere from, and just a snapshot of the companies we can deal with, 11 or 12 different companies. But you're looking at anywhere from $86 a month, to $130, $140 a month. So it's going to change for everyone. Now, rates are slightly different depending on your occupation, your age, of course, smoker, non-smoker, and of course, how much cover you want. And then the next example, we've got a female, age 40. So that previous one was a male, age 35. So there's an additional 5 years. Non-smoker, office-based duties again, but this time we've gone for $1 million life TPD and critical illness. And you'll just see that the additional 5 years of age, plus we're doubling the premium, has made a bit of an impact to the cost of the insurance. So if we just go to that next one, Ryan. Yeah, as you can, oh, no, not that one. That's the one. So as you can see there, you're looking at anywhere from $380 to $600. So your insurance usually does step up each year as you get older, making the premiums more expensive each year as you get older. But again, hopefully over time, the need for the insurance may diminish as the business is building equity, or as you're paying down equity, you're growing your own equity in your own home, or whatever it may be. The need for the insurance over time will diminish, offsetting some of those increases. This one, I thought I'd just add this in. This is something that sort of flew under the radar a little bit. Protect PYS legislation, or Protect Your Super, came in 2019, and it was designed for the situation where younger people were having their superannuation eroded by fees and insurance premiums, and they might not need that insurance. So that was the idea behind it, to try to not to erode the superannuation balance of younger employees or younger startups. But what they did, or what the government introduced, was that if you haven't touched your super for at least 16 months and you have insurance inside that super fund, and that doesn't matter whether it's an industry fund or a retail fund or whatever, but if you haven't touched your super for 16 months, by law, the superannuation fund now has to cancel your insurance. So this was introduced in 2019, and we're starting to see a little bit of it now, where people are trying to put in claims and not realizing that their insurance has been cancelled. I thought I'd just bring that one up because obviously, being a lot of you are self-employed. I know that superannuation, personally, I used to be self-employed. Superannuation gets put on the back burner a little bit when you're self-employed. You pay yourself first, and you always have the intention of topping up your super at the end of the financial year. That doesn't necessarily happen. Just bear in mind that if you do get a letter or an email from your super fund, don't just put it on the kitchen bench and forget about it, or pop it into your junk mail. Just make sure that, if you are relying on that insurance within your super fund, that you have, you need to make your fund active within that 16 months. So how do you make your fund active? You can change investment options, you can update your beneficiaries, or you can add some money to it. Now, depending on who you're with your Australian Super or Rest or whoever, you might just have to add $100 for the year, and it keeps that fund active. So just bear in mind that if you can do that minimal amount and not put everything on the back burner, you're going to avoid having your insurance cancelled when you weren't expecting it to be. There's just one other thing. It's not on the slides. I just wanted to run over two other things. Obviously, on my profession, being a financial planner, I'm CFP qualified. I've been a financial advisor for 25 years. It's longer than I like to admit these days. But after the Royal Commission, a lot of advisors left the industry. They were disillusioned and left, and the number of advisors went from about 30,000 in Australia down to about 15,000. Out of that 15,000, there's only about 1,000 that specialise in insurance. And so not a lot of people are looking after, your insurance funds, your insurance policies these days. We had an example with a company here. I was setting up the buy-sell funding for the two owners of the business, and the CFO sat in on all the meetings. At the end of the process, the CFO said, "Paul, would you mind having a look at my personal insurances? They're with a company called Tal. I said, yeah, no problem. Send them across. I'll have a look. And I knew that this gentleman had had a bit of time off the previous year, but I didn't really know what for. So I got all his details and then gave him a call about 2 weeks later. I said, change his name to Gareth. So Gareth, why did you have that time off last year? He had a valve replaced in his heart. He had a trauma policy, existing trauma policy, but because he didn't have an advisor, he didn't know anything about it. He didn't know he was entitled to a claim. Within 1 month of seeing me, I had a payout for him for over $380,000. Now, that's not just me, that the policy was in place, but the point was he hadn't been seeing anyone, or no one had reviewed his own personal policies. He didn't know he was entitled to that. So we got that money to him just before Christmas and made his year basically. So that was a fantastic result for him. He's obviously still a great client of ours and refers a lot through. But all that the point of that little story is just to make sure that someone's looking after your policies. Someone's looking after them. If you don't have an advisor, you don't have any policies, we'd love to help out. I hope I haven't talked your ears off and gone for too long. I hope that you've been able to understand a little bit what we're talking about. Just as a real quick summary, your buy-sell insurance is when there's 2 or more owners. If something happens to me, Amy's got the money to buy out my family. Fairly simple. Key person insurance might be 1 or 2 owners or key people in the business. Someone brings in the majority of clients or the majority of revenue. Excuse me. You may need to cover that person if they can no longer work. Get someone in very quickly so that the profits do not nosedive. And then, of course, you've got your own personal insurances on top of that, your life TPD, critical illness, and potentially income protection. So have we got any questions there, Ryan?
Actually, I just wanted to say thank you, Paul. That was great. I know I learned a lot, and I'm really glad we recorded it so we can send this out afterwards. Really valuable stuff. I really appreciate that. Now we'll take some questions from the crowd. I think there probably is anything specific you want to go over or anything high level, just let Paul know. But feel free to either just raise your hand or just come off mute and you can ask your question, or you can put it into the chat.
Hello.
Yeah, go for it.
Hi. So my name is Kristen, and thank you, Paul, for an excellent presentation. Actually, this was a very interesting topic for me because professionally, I'm an actuary and I'm also an entrepreneur. So a lot of ideas I was looking for personally how to find. The first one would be that if the business is in a growing stage, are you able to hear me?
Yeah, you're just jumping in and out a little bit, but sorry, keep going.
Okay. So I wanted to clarify, number one, that if the business is in a growing stage, so let's say in the initial 5 years, where the growth is exponential. So
No, we've lost you, sorry.
this, let's say we are talking about T-man insurance. So
sorry, keep going.
okay, sorry, it's a bit difficult. So I was saying that the valuation of the business, because that becomes the sum assured for the policy. So this will be challenging because the business is growing. So the first point I would clarify that how do you find out what's the underlying sum assured?
Yeah, that's a great question. Thanks. So I'll just make sure I've got the question right. So the business is starting up. It's in its first 5 years. It's got huge growth potentials. How do we value that business? Yeah. So as I said before, that's really not our area. So we would have meetings with yourself, your accountant perhaps, or any investors that are in your business to get what you feel the business is with. Now, if you think the business is worth $50 million, we might struggle to get that level of cover. But basically, if we go off today's financials, it might only be showing a valuation of 500, but you think it's worth easily $5 million. So we could probably meet somewhere in between there, and in discussions with yourself and your accountant. We might be able to put something in place for say $2.5 million. But as the business grows, what I should have mentioned earlier is you don't always necessarily have to insure for the full amount of the business. In that scenario, if we insured for $2.5 million and you believe the business is worth $5 million, the remaining $2.5 million, so something happens to me, $2.5 million is paid out. The remaining $2.5 million could be paid to my family over a number of years, like a vendor terms agreement, whether that be 3, 5, 7, 10 years. As long as it's in the agreement, as long as it's in the partnership agreement and the partners have signed off on it, that should be fine. But the actual valuation, we do have conversations with your accountant, with yourselves, to help determine that. But there's no set rule. It's mainly just making sure that the owners of the business are all agreed to the one valuation method. And that way there shouldn't be any arguments, or there shouldn't be any conflict when one of those partners has passed away, because we just follow that same valuation method. The accountant will then provide us with the valuation based on that method. Thank you.
Cool. And I think we have maybe one in the chat. Oh, wait, no, not yet. I did get a text from somebody during the presentation, and it was the question was, how much would your average buy-sell insurance policy cost for a startup?
How long's a piece of string? It depends. There's a few factors. So it depends on how much cover or how much insurance you want, as we just explained, whether that be 500,000, $2.5 million, $5 million. But as we said, as we saw in a couple of those examples, that was for key man in those examples. For 500,000 life and TPD on that first example, you'd probably be looking at, for the male, age 35. So if we take the trauma out of that, you'd probably be looking at around about $40 or $50 a month. And on the female example, we take the trauma out, you could probably halve those premiums. The trauma is the one, or the critical illness is the one where you're probably going to make a claim before the other two, and therefore it's always a little bit more expensive. So you take at least a third to a half off those ones, off those examples.
Yeah. Okay, great. Anybody else in the chat that have a question on either insurance or PSC? We're going to be having an event with them coming up a little later this year as well. So we'll have some more in-person type of fun. But yeah, this is pretty invaluable for our community, just because we don't want to just support you as you're growing in your business, but we do want to support you in growing as on a personal basis as well. So we want to make sure everyone's protected. If you do have any questions that you maybe think of later, that's totally fine. You can just email here, paul@psclife.com.au, or you can email myself. I'm Ryan Burns. I'm the head of community here at the Startup Network, and you can reach me at ryan@thestartupnetwork.com.au. Paul, you have any closing thoughts for us? Any pieces?
Is there one in the chat there? I think I can see. I'm not sure.
Let me see. It just says thank you for the presentation, which is very nice. Thank you.
No, our pleasure. Just final thoughts. I know it's not, a sexy subject. It's insurance, and it is what it is, but it is very important. As I said, that situation with the 55% owner and the 45% owner, that poor 45% owner dealing with the elderly mother, can't afford to buy her out on his own, can't get new investors or new partners in. It's just a really sad situation, because he's been in the business for 10 years. Spend a couple of hours on the agreement, get it drafted up by a lawyer, put the funding mechanism in place, and you'll never have that worry again. And we're there. We're here to help you. And obviously, Amy and Gareth, here to help on any of the business insurance side of things, which I know nothing about.
No, that's why you go to PSC, because you get that full range of services from all different angles for all of your insurance needs. Plus, they're just really nice people, and we're really happy and thankful to be partnering with them this year. But again, if you have any questions along the way, just let us know through email, or you can attend our future events. We have our Founder Connect event coming up on March just around the corner next Tuesday, so March 12th. And yeah, go ahead, Paul.
Sorry, Ryan. One last thing I forgot to mention is that if we do help out any of your members in the startup network, we can offer a PSC Life discount, which is over and above any of those premiums, and that's for the life of the policy as well, not just 1 or 2 years. So that's another incentive for your members to maybe reach out, and of course that can also that can also apply to their personal covers as well, their own family protection as well.
Great. Excellent. And we'll go ahead and send out the recording of this afterwards, and along with everyone's contact information. But again, thank you so much for joining us, and thank you, Paul. Really appreciate that. And thank you, obviously, to our friends over here at PSC. We'll see you next time. And for all the founders out there, keep building, but make sure to take care of yourself on the personal end too. We're here for you. Okay. All right, folks. Have a very nice day.
Thank you.
Thank you.
Bye.